Since the expectation is linear, this is quite easy to find because we know this is our portfolio equation. I can just take the expectation of both sides of this equation and distribute the expectation then to each of the individual risky assets. So that's what I'm going to do now. I'll take the expectation of both sides. The expectation of the portfolio returns is then equal to W, the expectation of the returns for asset A, plus 1 minus W, the expectation of returns for asset B. All right, now we're going to do some witchcraft that I call algebra. We're going to subtract then this equation from this equation. And we're going to make a substitution for 1 minus W just so we don't have to deal with it. We're going to call it Q. So what I'm going to do here is I'm going to say 1 minus W is equal to Q. And I will subtract these two equations from each other. So it's going to be R of P minus this side, and then this side minus this side. I can then factor out the weights, and I'm going to be left with just differences of the random variables and their expectations. So this will be then RP minus the expectation of RP, which is equal to W times then we have RA and the expectation of RA. And then, of course, RB, now weighted by Q, minus the expectation of RB. Now that we have this guy here, this looks quite familiar because this difference shows up in the equation for variance. So I can just make then the substitution of this guy in for variance, and that's exactly what we're going to do here. We're going to recall that the variance of our portfolio is equal to the expected square deviations of this difference, that is the random variable's distance from its mean of our portfolio returns, and we're going to substitute in this right-hand side. So we're going to get W times R of A minus the expectation of R of A plus Q R of B minus the expectation of R of B, and all of that is going to be squared, all inside the expectation. Now is the time for some more witchcraft. It's going to be to expand that square. To expand this guy, we are going to have to square each of these terms and then produce the product of the two times 2, that inner cross term. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, QuantGuild has 2 crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long-run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to QuantGuild if you're interested in these free resources.